Hey everyone. So now that we have learned our debit and credit rules and we have learned how to use those, we now know how to journalize our transactions. I wanted to talk to you about posting and our trial balance. Posting is simply taking our information and pretty much copying it from our journal to either a T account or what we call a ledger account. This posting process allows us to always know the balance of any particular account. So give me just a second and let me share my screen. Okay, so move this. Okay, these are just a few T accounts. So up here on the top left, we have a T account for cash. Okay, so cash is an asset, correct? That means it is increased by a debit and it is decreased by a credit. Now, notice I do not have the words debit and credit written up here like maybe we did previously on some, because by now we just know this. We know this left side is the debit side and this right side is the credit side. And since cash is an asset, then we know on the left side, these debits are increases and these credits over here on the right side are decreases. So where we got money and where we spent money. So just want to do a little refresh on that. And let's talk for a second about how we get a balance of our T account. This is just simple math. So if we know 400,000 and 20,000 are increases, then we add those and we know 1,000, 15,000, 800, and 1,000 are decreases, so we subtract. So 400,000 plus 20,000 minus 1,000 minus 15,000 minus 800 minus 1,000. Do the math, and that gives me $402,200. Oops. How do I know which side to put that number on? Well, two different ways. Mathematically, we know that this side was greater than this side. So therefore, the remainder would go on the greater side, which would be the left side. By our accounting rules, we know that assets have normal balances of a debit. So our balance should always be over here in the debit side. Now remember, in the quote, real world, anybody ever bounced a check, overdrawn their account, spent money you didn't have? Okay, don't feel bad. It happens to the best of us. We could have a credit balance because we could have a negative balance in our asset. But in our safe little world in here, remember, unless the problem tells you, then you can always assume normal balances. So just take a second and look at these other accounts. Receivables, accounts receivable, trade receivables. Anytime we're receiving money, that's an asset. So we've got a positive 24,000 on the debit side, a negative 20,000 on the credit side, and our balance would be 4,000. Service revenue. Service revenue would be a revenue account. Revenue accounts are increased by credits, decreased by debits. So I only had one entry and it was a positive. So that 50,000 becomes my balance. Okay. One more thing I want to point out about T accounts, just like in our journal, notice there are no positive signs or negative signs. We just know if it's on the left or if it's on the right, according to what type of an account it is, our debit and credit rules, we just automatically know whether it's a positive or a negative. Okay, so let's look up here at the top. This is an example, just a simple journal entry, okay? We sold goods to the customer for cash. If I received cash from my customer, then I know my cash account is going up. Assets are increased by a debit. And so I debit cash, $55,000. If I sold goods to the customer, then I know I earned revenue. And so my revenue account, in this case, sales, will go up, and revenue accounts are increased by a credit by 55,000. All right. So remember, I've got you that video on journalizing. So if that didn't make sense to you, you need to go back and watch the previous video on your debit and credit rules and journalizing your transactions, because this isn't the new part, okay? The new part is posting. And on this slide, we are posting to our T accounts. Remember earlier, I said posting is basically just copying. So I look up here, and in my journal, the date is July 16th. I go to the first line, and I've got cash, a debit of 55,000. So if we follow this red arrow down here, we have a T account for cash. The date, July 16th, a debit of 55,000. That's it. I'm just copying. My next line, sales, credit, 55,000. So I follow my arrow to find my T account for sales. I put in the date, July 16th, and I put in the credit, 55,000. So I'm simply copying the information from the journal to the T accounts. Why? Why do I need this information in two different places? Well, our journal shows how things fit together, what happened. If I look at this journal entry, then I know that I earned revenue and received cash. My T accounts, where I post, that's going to show me all my cash happenings in one spot, all of my sales happenings in one spot. So basically, our journal is a chronological list of everything that happened in our business. Our T accounts are going to be all the cash together, all the sales together, all the land, all the supplies. And so instead of giving me a chronological account of what happened, it shows me according to a specific item, cash. Let's look at another example. In this example, we have our journal entry up here at the top, but we are posting to what's called ledger accounts. So we're going to use these instead of T accounts. The advantage of these type of accounts over T accounts is that I'm going to have a continuous spot for my balance. If we look back for a second, look at these T accounts. Notice I didn't find a balance after every single day. Every time something happened, I didn't get a new balance. I didn't get a balance until the end of the month, January 30th. That's not necessarily good, because what if my boss comes in and says, hey, Michelle, what's our balance in cash today, January 15th? I can't just look at it. I've got to figure it out. I don't want to be figuring it out while he's standing there waiting. So if we use ledger accounts, and I've got these dedicated balance columns, like look down here at this cash account at the bottom. Notice every time I posted a debit or a credit, then I calculated a new balance. That comes in very handy. So we really like these ledger accounts. For the most part in the real world, we use T accounts for figuring out a balance really quickly. But for our everyday keeping an eternal record of my account balances, we normally use ledger accounts because it can just go on and on and on, but I always know the balance. So let's look up here at our journal. We have a debit to prepaid insurance of $2,400 and a credit to cash of $2,400. So that is my journal entry. When I'm ready to post, just like when I was doing T accounts, I'm still copying, okay? So I go to my first line, December the 1st, prepaid insurance, debit, $2,400. So I'm going to follow this arrow down here to my prepaid insurance account. I'm going to copy the date, December the 1st. I'm going to leave this item column, excuse me, blank for now. As long as we're just posting normal everyday transactions like we are in this chapter, we're going to leave this blank, okay? I'm going to go over here to the debit column and I'm going to put in $2,400. Why am I putting it as a debit? Because up here in the journal, it was a debit and I'm just copying. So we have our debit and credit column, and then we have our balance debit and credit column. If this is the very first entry, because there was no previous numbers in this prepaid insurance account, it had a balance of 0. And so if I have a debit of $2,400, then I know my new balance is going to be a debit of $2,400. Now, something we didn't use in T accounts, but we will use in ledger accounts, another reason they're kind of better for the real world, is we're going to use what's called our posting reference. So notice up here in your journal, you have a column that says POST-REF. That stands for posting reference. If you look down here in your account, in your ledger, you have a column that says posting reference. We're going to put numbers in both of these. So we've talked about how every account has a number. If you look down here, prepaid insurance, go over to the right-hand side of the account, says account number 15. Cash, go over here, says account number 11. So when I post, I'm going to go up here to the journal, and in the posting reference column beside prepaid insurance, I'm going to put 15 because that's the account number of prepaid insurance. And in the posting reference column on the cash line, I'm going to put 11 because that is the account number for cash. So our posting reference in the journal shows what account number I posted to. My posting reference column in my ledger accounts shows what journal page this information came from. So if you look up in the top right-hand corner of your journal, it is page 2. So on this line in prepaid insurance, where I posted my $2,400, it came from journal page 2. Down here where I posted my $2,400 in cash, it came from journal page 2. So let me say that again. The posting reference column in the journal will always be the account number that you posted to. The posting reference column in the ledger will always be the journal page number. So these posting references basically link together your journal and your ledger. You can always figure out where your information came from. It creates like this big paper trail. Make sense? Okay, let's look down here at cash for another minute. Let's talk about these continuous balances. So I see on November the 1st, I had a debit of $25,000. That was my first entry, so that became my balance of $25,000. Then I don't know if y'all can see very well this like blank white space right here. That just means we skip some information so it can fit on the page. So now go down here to November 30th. We had a credit to cash of $2,000. And it said that my new balance was $5,900. Okay, Now, December the 1st is when we're posting our entry from up here, our credit to cash of $2,400. So I come over here, I put $2,400 in the credit column, and now I'm going to update my balance. Well, right here, the balance immediately before this entry was $5,900, a $5,900 debit, which is a positive, and my posting for this entry was a $2,400 credit, which is negative. So 5,900 minus 2,400 gives me a new balance of 3,500. And that's how we will always calculate our new balances. Remember, our debit and credit rules are just pluses and minuses. So we can use our accounting knowledge, our rules, well, a debit minus a credit, because opposites would always subtract. But we can also just use our math rules. A debit is a positive for cash, a credit's a negative. If you have a positive and a negative, you subtract. If you have two positives, in this case, two debits, you would add. If you had two credits, you would add. Opposites, you subtract. So just like positive and negative numbers when we are doing math. This is an example of a cash account with a whole bunch of entries posted to it. All of our November entries that we've talked about and all of our December entries. So notice once again, after every single posting, we have a balance and we have what we would call an ending balance, whatever the last balance in the account is. So our ending balance for cash right here is how much? $2,065. If I look up here at land, $20,000. Office equipment, how much? $1,800. And accounts payable, how much? $900. And for cash, land, and equipment, my balances were in the debit column because those are assets. Accounts payable is a liability, so its normal balance is a credit. Okay, so once we have all of our journal entries posted, this is an example of what our accounts in our ledger would look like. Remember these numbers for a second. Once we finish journalizing and then posting, we're going to do what's called a trial balance. A trial balance is simply a listing of all of our accounts, and we list their balances. Debit balances in one column, credit balances in another. We add them up, and guess what? They equal. In this case, 42,600. So stop and think with me for a second. When we are journalizing, debits always equal credits. Every single journal entry, debits equal credits, which means all the debits in the journal would equal all the credits in the journal. Okay. Then we take that information from our journal and we put it into our ledger accounts. We're just copying. So if debits and credits equal in the journal, shouldn't debits and credits equal in the ledger? Yeah, same numbers, right? Then I take these numbers, these balances, and I put them in a trial balance. So should the debits and credits equal? Correct. Yes, they should. They have to. If they don't, we've made some type of mistake somewhere. So basically, debits and credits always equal in the journal, in the ledger, on your trial balance. Now notice this is called an unadjusted trial balance. We'll talk more in the next chapter about why it has that name. Okay, no need to worry about that now. So remember that number? Cash was 2,065. Land was 20,000. Office equipment was 1,800. Accounts payable was 900. And I didn't show you every ledger account. Those are just the ones that I showed you. But so you see where we are getting these numbers from. So basically, y'all think about this. The journal is the hard work. Once you get your journal entries right, you're just copying. You copy from the journal to the ledger and from the ledger to the trial balance. So posting and trial balance, once you learn them, they're easy peasy, lemon squeezy, right? So focus on getting those journal entries correct so that everything that follows is correct. Let me stop sharing my screen. Okay, guys, gals, thanks for watching. As always, please let me know if you have any questions, and I will see you soon.